Commodities are in a supercycle. Well, it depends who you ask. We are witnessing an incredibly precarious time in which assets are sky high and the economy is generally historically weak. With increased expenses, this puts additional strain on those millions of people who are struggling, the ones who really need everything to stay low in price. But from gasoline to a trip at the grocery store, more people are spending much more every single day. But don't worry, there's no inflation. You came here for the truth, so let me unveil that for you. They try to tell you that there's no inflation, but my goodness, you and I both know that it's going on. You just have to look in the right place. We are going to talk about commodities today at the beginning. Then I want to show you what's been happening in the financial sector, and this just keeps getting crazier every single day. There are so many charts, so many articles that I go through. I don't have time to keep up with it all. I really don't. This is becoming a problem for me here. And this whole program is me trying to dissect a whole bunch of information in a given day. And trust me, it's becoming difficult because as time goes on, there's just more and more and more. And I'm able to dig through more. I'm able to look through more. And that just brings more work on my plate here. It's difficult, but hey, I'm going to do what I can. Let's get into it right away. Commodity prices are surging, just don't call it a super cycle. This is out of the Financial Post, and they wanted to make sure you know that this isn't a super cycle, okay? It's expected to be a 2-year bull market. 2-year, not 3-year, not 1.5 year, but specifically a 2-year bull market. That's right, because all of their other predictions are absolutely accurate. Anyway, this is what they're saying. It's not a super cycle. It's just 2 years. We'll see what happens. I'm going to show you some prices right now. 6-month spot price percent change in US dollars. Take a look. You can see right here, WTI 40%, Brent 36%, natural gas, nickel, copper, all of them have accelerated quite a bit over the last 6 months. Here's the Bloomberg Commodity Index total return. This is over the last year, and clearly since March 2020, it's been going up and up and up and up. And this just tells you that we are encountering this inflation that takes place not just in, let's say, Bitcoin or maybe Amazon stock or what have you. No, we're seeing it everywhere. And the prices which have increased could be in many different ways showing up here. And the whole point, the whole reason I mention this is that it affects people and their bottom line. If somebody's making $250,000 a year, if the food prices increase by 20%, 30% year over year, that would be significant in terms of percentage, but it doesn't do much to the bottom line. However, if somebody is making $30,000 a year, yeah, that's going to hit, that's going to hurt. You could break it down by commodity and see what's been happening. This happens to be soybeans, and you're looking at it over the past year. It has accelerated just like everything else. There are certain cases where you find where there was a shortage or there was some crop damage for some reason, or suddenly China had to buy up more of it, so it puts more demand. Then you see the price increase. But look, if you just break it down and actually look at it all, this is happening all over the place. And again, bottom line is people are paying more. Now, the prices you're going to see here, by the time you're actually watching this video, who knows what they're at. But I just wanted to show you very clearly that the price of crude oil has increased. If you remember, I covered it here on this channel. We had seen some of the different futures for oil go into the negative. It was something that had never happened before. But of course, now today, you're looking at WTI and Brent around that $60 mark. So it is quite significant to see it over a period of time going up this much. So anybody who was putting their money in when those contracts were around that negative, right at the bottom there, and betting that this was going to go higher, they certainly did very, very well, more so than the traditional names that you tend to hear, like, for example, everybody's recommendation, Jim Cramer's and Janet Yellen's recommendation of buying 7 shares of Amazon. This actually may have done much better. This should give you something to think about. Fund allocations to energy have steadily declined in recent years. So this basically goes back 2010 up until the present. Now, the red line is the energy equity allocation. Then we can see that broken down active and passive. The point here is that, yes, over the years, we can see that this has definitely come down. But if you look at it a little closer, I'm going to try not to mess this up, you can see that more recently, this has started to pick up. So there is more demand there, certainly. As these prices are increasing, we are seeing this starting to pick up in this case. I don't know what's going to happen. I don't know if it's a blip, but we'll see. Whenever there is this institutional demand, it's always going to drive the prices higher. This is coming, by the way, you could see right here, partly from the EPFR. So we know where the money is moving to and from, and we get that directly from the source. I wanted to stress this because, of course, this is going to create potentially a whole bunch of new investments that were depressed for a while. And now you can see that already some of them have come up. There's different companies out there that could be purchased as a result of, a boom in these different commodities. We'll look into that further, of course. I don't like to give financial advice specifically, but I can show you what's happening and then you can make the decision. But I'm showing you early right here in this upswing, and we'll see if it continues. Warren Buffett's favorite valuation metric is ringing an alarm. You've probably seen this a lot recently. Why? Because it keeps breaking its record. It keeps going higher and higher and higher. The U.S. equity market cap is more than double the nation's GDP. We've never seen anything like this before, and yet there's nobody out there suggesting that this should correct at all. Not a correction, not a crash, not a collapse, none of the sort. Here you have it, the Wilshire 5,000 market cap versus the US GDP, and it accelerated far beyond what we saw during the dot-com boom and bust. But you don't have to worry, because this time is different. These are a few others. You can see the expanding multiples. Some S&P 500 valuation metrics are eclipsing dot-com peaks. This one right here at the top, the black line, S&P 500, price to tangible book value per share. That's accelerated to such a great degree. And by the way, this chart starts at 2000 and goes onward till today. And at the bottom, this is the price to sales ratio. We have never encountered this type of accelerating trend, especially when the economy is weak. It's absurd. Given the scale of fiscal stimulus, one would expect the Fed to be thinking of leaning against the wind, but not this Fed. The Fed is using the same playbook from the Great Financial Recession, providing, and I love this, unneeded stimulus to the red-hot housing market. It was already going up and up for years in general. I mean, you could look around. There were some weaknesses happening by the time we got to early 2020. But in general, that index had moved up quite a bit, really fast. In fact, if you look at it on a historic basis, some of the places were up to 10%, 12%. In a given year-over-year scenario, that's way too hot for real estate. And now it's just crazy in some places. What's the economic and financial endgame? It's hard to see anything but a boom-bust scenario playing out with fast growth and rising market interest rates in 2021 and early 2022, followed by a bust in late 2022 and 23 when the fiscal stimulus support dries up. Now, that's not what I'm suggesting here, but I just wanted to read that to you because right here they make a point. The sugar high today is unprecedented, raising the odds of a harder landing. And that's what I think people do not understand. I say this all the time. You look at it, it's a wave. This is in nature. This is in the markets. You can't change this. What the Federal Reserve is trying to do is basically take it on the way up. Now, when things are starting to come down, they actually can prevent it. Oh, no, we'll stay right here by keeping interest rates low, and we'll make sure that this thing will chug along sideways until we can hit the next wave. This is absolutely ludicrous. I don't know why people believe it, because the Federal Reserve has been in operation since 1913 and maybe 1914 technically. And you look at it when they were acting and reacting in the way they do, there has been booms and busts and booms and busts. And of course, if you look at the last few of them that we've had over the past few decades, it becomes more exaggerated every time, on the way down, on the way up. And they are unwilling to admit it, of course, but everyone just keeps begging and pleading with them to do more. 2021 looks like a black hole for battered European tourism. Across Southern Europe's tourist hotspots, all they can do is get ready and hope. This is what's happening right now, and Europe is just one place that has been hit hard. Of course, there's areas, and I'll show you just a second, that rely on that tourism, but it's not happening anytime soon. This chart shows you the proportion of GDP generated by travel and tourism. The darker the red, of course, the higher the number. You could see areas, whether it's Portugal and Spain and Italy and Greece and so on, that they're highly reliant on that tourism. It hasn't been coming in. And so what's going to happen to their economy? It's going to sink. That's why they're dealing with that right now. And what do? Well, we're not bringing that money in, so the money's not coming in, but we still have to do things in this particular country. Okay, well, there's one option, and that is raise taxes on the middle class and make sure that they pay up. Make them pay, because that's going to fix the problem. Well, they don't have any other things to do except their austerity measures and raise taxes, and in the end, it only slows things down. It only makes it worse. If you're in the mood to laugh a little bit, you could read this article out of the Wall Street Journal. If Tesla bubble bursts, catastrophe won't follow. Not all bubbles are equal. Britain's bicycle stock bubble of the 1890s holds lessons for today's electric vehicle mania. Look, the problems that we have are not just one stock. That's ridiculous. It's not just because Tesla stock has gone up, and if it comes down, it's going to drag the whole market with it. There have been so many stocks that have been doing the exact same thing as what we've seen with Tesla. And this is truly a disservice to all those people who read it and think to themselves, you know what? He's right. Yeah, he's right. This is what I show you because I break down the information. People are sometimes, they're on this channel, they're wondering, they're saying, you never even told me which stocks to buy. Why would I watch this guy? It's not about that. It's about dissecting the information that they put in front of you. And then if you can wake up to it, you would only realize that, my goodness, the entire time, this was all propaganda. This was all lies. And the vast majority of people will go through their entire life and never realize that. Indoor dining at 25% capacity is not enough to stay alive. Some NYC restaurateurs say, oh no, they want 50% apparently. Look, if you're not at 100% capacity, or at least what you could do, how are you going to stay in business? A lot of these places cannot stay in business even at 100% capacity. If somebody's forcing you down at 25%, I mean, honestly, how do you remain in business? That's a question. If you do own a restaurant, know somebody who owns a restaurant, you got some information to put down, please put it in the comments. We need to know what's going on. I'm seeing a lot of data that is looking very negative for this particular sector. We have seen so many different companies out there that have been either saying that they're going to buy or have actually gone ahead and bought Bitcoin. Morgan Stanley may bet on Bitcoin in $150 billion investment arm. We don't know what's going to happen here, but I'm just showing you that there is this desire to get in on Bitcoin. There's been multiple funds in different countries that have been set up, and they essentially will allow people to take their 401k and drop some of that into this Bitcoin, but not directly Bitcoin, of course. They want it in a fund, so the fund manager can make their commission. So this is something that I've been noting. It's been going on. The reason that they're doing this is because they want the institutional side to actually start to engage with this in something that they would technically, if you just read the original white paper, they should want nothing to do with it because it's quite against the financial industry. But hey, the financial industry is all about making a buck. It's all about fees. It's all about commissions. And they don't even understand what they're getting themselves into. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you're supporting me. I want to thank you for that. Click a button on the way out to help me. Thank you very much. If you want to learn about e-commerce, you can do that for free at the AmazonGPS.com. And if you want to know about the financial industry, I'm talking about everything. It'll teach you what you need to know. You can look it up in these 2 books, link in description. If you haven't seen it already, you definitely want to check this video out. Lots of detail in here. Click it. I'll see you there.